In this video here, we're going to be doing a stock analysis on Exxon Mobil. Now, I covered this company several months ago, or maybe a few months ago rather, when they just recently exited out of Russia and they ceased operations over there. So we're going to load this up in the stock research tool. We're going to do an analysis on the fundamentals and financials using our financial evaluations category, and finally do a price analysis afterwards to determine a fair price to pay for this business. So we are ranking Exxon Mobil 7 out of 10. So we're going to dig through these 10 key categories and determine what that means. So looking at our 5-year PE ratio, we're sitting at 16.63. Now we want this number to be underneath 22.5, so we're going to give it a point there. And we're also in a trailing 12 months category in a company metrics section here. It's sitting at 15, so that's great to see. The price is actually just a sidestep. It's been on an uprising trend lately. So this is comforting to know. In full disclosure, I actually own shares of Exxon. I purchased in around the $40 price range, so I'm happy to see this increase. However, I would like to purchase more if the business makes sense, but we'll see if it's undervalued or not. Jumping in to our current ratio, sitting at 1.07, we're giving it a 0 here, folks, because ultimately we want to have a decent margin of safety, and 1.07 is not a terrible current ratio. That means they have an equal number of assets and an equal number of liabilities, so the two will cancel out in terms of covering their liabilities with their assets. However, we want this number to be over 1.5. That 0.5 would indicate a decent margin of safety just in case anything goes wrong, and we like having a margin of safety just in general. So 0 there. We're getting a 0 on our return on equity average, sitting at 5.65. Ideally, we want to see this over 15%, and 5.65 is not there. Obviously, it's not there, but in our trailing 12 months, however, we are sitting at 15.70. So it looks like they're on the upswing now, which is great. EPS growth, some massive growth here, sitting at 439%. Debt to equity is sitting at 25%. These are phenomenal numbers. Now, we want to see this under 50%, folks. This indicates to us that Exxon Mobil is building the business through equity. And they're building the business through equity and not through debt. And especially now with interest rates rising, it's comforting to know that a company is actually taking this initiative to be building the business this way. And I believe in my prior evaluation, I believe this number was different. I believe it was much higher. Moving on to our other 5 categories here. Share dilution, they are buying back shares, which is great. The only caveat with that would be if these shares are overvalued and overpriced, we don't want to see them burning through their cash flow to purchase back these shares. If they're undervalued, then yeah, sure, by all means buy them back. But it's good to know that they're buying back shares because that allows you, the shareholder, to own more of the business. Flipping into our net income growth, or some net income growth is there, so we're 16%. 5-year free cash flow growth, we are also up, and on average we're sitting at $14 billion for average 5-year average free cash flow, and now we're sitting at $40 billion for our trailing 12 months. Huge jumps over our trailing 12 months, or average rather. I mean, look, we kind of went from we did a full 180 where people were not traveling during the COVID season, right? And now people are out and about and traveling all the time. And listen, in the States, gas prices are skyrocketing. Here in Canada, same thing. We are seeing record high gas prices. So people are filling up at the pump more and more. And look, they're paying a pretty penny for this gas. So makes sense. Makes sense to me. Now, our return on invested capital average, however, that is struggling and lagging behind, sitting at 2.79%. We want to see this number over 10%, and we're so close in the trailing 12 months. They are really turning this company around. I got to say, this year has been the year for Exxon Mobil. And a 5-year revenue growth is up at 8.52%. Not bad, considering it's a $375 billion company. I just want to go to our free cash flow out of curiosity, because one thing did stick out to me, and I'll point that out to you. We pay out a dividend. This is a dividend paying company, 3.83%. And that pays out to $14.9 billion. Our average 5-year free cash flow is $14 billion. You see where the trouble is over here? We must be taking on some sort of debt in order to be paying out these dividends. So folks, something to keep in mind. This is a slight red flag. Now, if they're able to keep up the free cash flow in this range, that is phenomenal. So we're going to go into our free cash flow statement and just take a look. And take a look at this, guys. 2020 destroyed. 2021 they came back with some force, but it's been rocky. Like, this is 2019, and then yeah, some pretty solid years here in 2018, 2017. But I'm not liking that. I'm not liking the amount of free cash flow that's being paid out to dividends. It doesn't really make sense to me. Like, consistently they're paying out the dividends, but they don't have the free cash flow to back it up. So I want to see maybe their long-term liabilities. What does that actually look like? What is their long-term total liabilities? Oh my God. Yeah, that's not healthy, guys. Look at the long-term liabilities. And our free cash flows numbers are lagging behind. I mean, it's dipped a little bit, but however, it's jumped up quite a bit for, this is a quarterly. Let's go annual, just out of curiosity. Let's get hurt a little bit more. Let's see what that number is. Yeah, 163. Yeah. Now, $163 billion, guys. I don't like that. I don't like that for this. And with the revenue increasing, I mean, this is one good year. It's one off year, but it's going to, balance out the previous year that was absolutely horrendous. So I don't know how I feel about that so far, guys. This is something to just keep in the back of your mind. If they're taking on debt to pay out these dividends, it might be worth getting rid of the dividend altogether. However, you're going to probably lose a lot of investors that buy it solely for the dividend. And honestly, you shouldn't be doing that in the first place, guys. Don't buy a company just for the dividend. It's tax inefficient, one. And two, look, you're banking on a what? 3.83% check every single quarter, and this company might be hypothetically could be devaluing, depreciating in value. Luckily, Exxon Mobil is appreciating in value, but if you're buying companies that are not doing that, what's the point? What's the point? Dividend is the cherry on top. Just don't buy it just for the sake of it. But I own this company because I just believe in oil long term. That's just my stance on things. I don't think oil is going to be going away anytime soon. This dividend is nice. However, I don't like this allocation, I gotta say. Anyways, that's my opinion on that. We're going to jump into a price analysis. And if you're liking the video so far, folks, the like button, subscribe button, found down below here. Consider subscribing, doing those wonderful things. Makes me feel warm and fuzzy inside. And this software here that I have in front of me is going to become an app for my subscribers. So stay tuned. We're working diligently to get that out to you. It's going to be on a website. It's going to be phenomenal. And you'll analyze companies in an instant, as well as other features are going to be coming soon. But you have access to the income statements, the cash flow statements, the balance sheets, tons of different tools to use, and as well as this is the price analysis section, which I'll show you how this works, and it allows you to plug in different values, and then you can determine what is a fair price for this company. So we're going to jump into a price analysis for Exxon Mobil, and I'm going to fill out these lovely boxes, 10-year evaluation, and I'll touch base with you in just a quick second. All right, folks, so here is what I did. So looking at the revenue growth, I'm going to keep it within this 3, 4, 5 range. I want to keep it as conservative as possible, playing within our 5-year numbers. Now, 5% on the high side, 3% on the low side. It just seems to make sense to me, considering the market cap of the business, as well as how far can oil really go, and how far can this company really grow, and considering that they've now pulled out operations out of Russia, and where can they possibly go next? Ideally, it would be great if the sands in Alberta, Canada, were, harnessed. That's a topic for another video. Profit margin, I'm going to keep this at 2 to 3.5 and 5% on the high side, sticking within our 5 and 10 year numbers. That would make sense because I want to use numbers that I know that they can hit, as well as put a little bit of a margin of safety on it in case things get bad. So for profit margin, I'm keeping that super low. That makes sense to me. Now, free cash flow margin, same thing, 3.5, 4, 4.5. I believe they could probably hit those numbers. They've hit them consistently over the 5 and 10 year numbers here. Price to free cash flow, same thing. I'm going to keep it around this 9.76, as well as a PE ratio hovering around this 15, going 12 on the low end, 16 on the high end. Desired return, lucky number 13, and we're going to see that to pay for Exxon Mobil, we should be paying $34 a share. An average aggressive, if you believe these numbers here, it is at $50. Moderate is 30, 33, and $20 on the low end, given these parameters right here. So it's slightly overvalued. Actually, it's a lot overvalued, folks. But I'm going to be completely honest with you. I think I definitely overpaid for this business. I mean, I bought it literally around this price right here. And they weren't doing these numbers when I purchased this company. So I'll be frank with you. I think maybe I overpriced. I overpaid for it, but I believe that they were going to go into those numbers to try to justify it, and they did. They hit my estimations in terms of, because when I bought it, it was at the all-time, like it was pretty much the start of the pandemic when everything was just kind of just free falling. No flights, no nothing. No one was traveling. Gas prices were at all-time low. So that was my opportunity to say, you know what? It looks bad now, but it can't be bad forever. From that perspective, it made sense to jump in on this business and say, look, they're going to probably go back to their all-time highs eventually, or where they were prior before this whole pandemic. So they're currently doing that. So I'm up, which I'm happy. So we have massive growth in our 5 year and 1 year numbers here. So to me, I would confidently say it's probably in this range. I think buying it at 40 wouldn't be too bad. However, if by the chance of the gods it ever falls down to these prices, might be worth picking up. However, it is on a strong rally. I don't see that happening anytime soon. It just doesn't make sense given the circumstances with the Ukraine and Russia war, as well as, well, that's the predominant factor, right? Like that's the thing that's pretty much driving these prices up, and people are just rallying behind all the oil companies because of it. So hopefully when things get back to normal, these prices should calm down a little bit. But I don't know the future. I don't have a crystal ball. I just rely on my software and being calm and patient. Anyways, those are my thoughts on Exxon Mobil. What are your thoughts? If you want to see a company evaluated, write it down here in the comment section below. That's the video. If you want the software, stay tuned. It's coming out. Thank you so much for watching, and I'll catch you in the next one.